property tax calculations. You're going to need to know some math for this examination, and property taxes are a good one to get started with. So let's take a look at this and go quickly overview of how to do some property tax calculations. So what we're going to do here is we need to take a look at a couple of things. Number one, property taxes are based on the assessed value of a property. The tax rate is set by the local governments and is expressed as a percentage of the assessed property value. Tax rates are typically calculated per $1,000 of assessed value. And the example here is we have assessed value of a property at around $650,000. The tax rate is 10 mils or 1% of the assessed value. Remember, 10 mils equals 0.01. So they express tax rates in mils, and mils are the way that you calculate them is 1% of the assessed value. So the calculation is the property tax, if you're looking to get that calculated, is the assessed value, like 650,000 in this case, times the tax rate, which is 10 mils, which is 0.01. So then you take the property tax equals 650,000 times 0.01, and that gives you a property tax of $6,500. So you want to work through these. These are going to help you understand what you need to know about that. So that's a good one. That's some basic property tax calculations. You will definitely need to understand for real estate examinations everywhere in the country sort of what prorations are. And prorations are these sort of reconciliations between buyer and seller of the property. You know, you might close on a certain date. The seller might have prepaid for property taxes. Sometimes they might have prepaid for like fuel oil for the whole year, and they should get a credit back when they're closing if the buyer is going to benefit from it. So there's these series of debits and credits to reconcile payments in advance or payments that are owed. And those are called prorations. So let's take a look at this proration example and kind of walk through it. There's a different variations of each one, but in this particular one, I'm going to show you how to do prorations of real estate taxes. So let's take a look at this. All right, so prorating property taxes at closing means simply adjusting the amounts of taxes paid by the seller and the buyer based on the portion of the year each party owns the property. So the example here is, suppose the sale of a house closes on April 30th. This means that the seller owned the house for 120 days and the buyer will own it for 245 days. We're simply subtracting it out from 365 days to kind of know how long the seller owned it and how long the buyer is going to own it. Now, the annual property taxes are $6,500. We just looked at a previous example, and that's where we're using this from. And now the steps to prorate property taxes. Number one, we calculate the daily tax rate. So first find out how much the tax is per day. We have to be able to break it down. And the test will give you 365 days or 360 days, 30 months. So, you know, it'll tell you what to do so you kind of understand how to go about it. All right. So then we calculate that based off of a standard year of 365 days, and therefore we divide the annual property tax by the number of days in the year. So we'll do the calculation in step two. We take $6,500 divided by 365, and that gives us a daily tax rate of $17.81, if you round, 8.08 per day. Now, it's important that you understand that you're going to need to round many times to get to the number that you want to. They might go direct, but it's rounding that's something that you just have to get quickly comfortable with, and then you should be fine. All right, so the next step, step number 3. Now let's calculate how much each party owes in the property taxes based on their ownership period, okay? So we're going to go seller's prorated tax, daily tax rate times the seller's ownership days. So we learned that if we subtract out how long based on when they closed, the daily rate of $17.808 times 120 days that the seller owned the property for that year is $2,136.96. The buyer's prorated taxes, their daily tax rate times the buyer's days of ownership, $17.808 times 245 days is $4,362.96. Note that if the seller has already paid the taxes for the full year, this will show up as a credit of $4,362.96 to the seller and a debit of $4,362.96 from the buyer. So you see what we did here? All we did was we said, okay, the seller prepaid for the taxes for the whole year. Many jurisdictions make you pay for real estate taxes in advance of the year. So they get their tax revenue in advance of when they intend to utilize it. So they're collecting it in advance. Therefore, the seller prepaid the entire year, the $6,500 total. So the question really is how much does the seller have to pay? Are they obligated to pay? Well, they owned it and they closed on that specific date. And because they closed on that specific date, they only own the house for 120 days that year. And then the buyer is going to continue to own it moving forward for the rest of the year, which is another 245 days. Now we take that and we say, well, the seller should get a credit for that at closing because they already prepaid for it, so they'll get that money back, and the buyer owes that money, so it's coming out of the buyer's pocket, and that's the debit to the buyer's side. So there's a series of debits and credits, and that's how we do prorations. Check prorations in your books, and you're going to learn a lot about those. And you want to practice these for sure. We certainly will have lots of examples in our materials so that you can walk through prorations, but they're an important one. Another simple one that we want to do is rate of return or return on investment. Simple math calculation, but it's important that we understand this. This should be an easy win on real estate examinations. So let's take a look at the example. All right, so rate of return. Calculating the rate of return on an investment property helps buyers understand the profitability of an investment or potential investment. One common way to calculate this is by using the annual return on investment or ROI formula. The ROI formula is return on investment equals net profit divided by the investment cost times 100. The net profit is the income generated from the property minus all expenses. Example here would be maintenance, taxes, and interest, okay? Legal fees, etc. All of these things, once we subtract out, and then we're good to go. So let's take a look here at an example. You purchase an investment property for $500,000. You spend an additional $30,000 on renovations, making your total investment cost $530,000. In the first year, you've earned $36,000 in rental income. Your expenses for the property, including taxes, maintenance, and insurance, total $12,000. Your net profits after you subtract out those expenses from the 36 is $24,000. So net profit is the total that you've grossed in rental income minus your expenses, and that's your net profit. Now we plug it into the ROI calculation. The return on investment in this particular example, the rate of return here using ROI is net profit divided by the investment cost times 100, or the return on investment equals $24,000, that's the net profit, divided by the investment cost, $530,000. And you multiply that times 100, and that gives you an ROI of 0.04528 times 100, or in percentages, if we're looking to get the percentage, it's the return on investment is 4.53%. Okay. Now there are many different ways to measure your rate of return, and this is just a very rudimentary way, kind of a down and dirty way to do it. But many times in real estate examinations, they want you to do these simple ones to really understand what's happening. And where I see a lot of students might mess up, just a fine point here, is in converting that into a percentage. That's why we multiply by the 100 to be able to visually understand that as opposed to a decimal. And you just want to know that basic thing, and then subtracting out the expenses from the gross rental income, and it'll get you a crude number there. You also note in this particular example, they had that you spent an additional $30,000 on renovations, making your total investment costs $530,000. Sometimes they might give you an answer just based on the investment property purchase price, and then you forget to add in the $30,000. So really here, the test writer wanted you to understand that they wanted you to add in the $30,000 investment into renovations as part of your total acquisition cost, okay? Capitalization is an important one to understand. You saw capitalization rate definitionally inside of the appraisal section. So you want to know that is that the income approach to valuation utilizes the capitalization approach. Now, mathematically, you do want to understand how to do this. So let's take a quick look at this example here so you understand how this one works. All right, so suppose you are considering purchasing a rental property that generates $60,000 in annual income or rental income. After deducting all operating expenses, excluding finance costs, remember we exclude those, the net operating income is $42,000. So if they gave you, as a sort of a trick, they gave you a series of expenses, when we're figuring out cap rate, we exclude the mortgage payment, the debt service. So they might go, accounting, taxes, property management, mortgage payments, separate that, kick that one out, add up all of the other expenses. Don't include the mortgage payment, leave that out. Add up all of the other expenses and then move forward with your calculations. One of the wrong answers, the red herrings, might be that they give you an answer with the mortgage expenses included in as the expense. So just as a fine note, the mortgage payment is not an operating expense. It's debt service. So it's not calculated the same way in these calculations. Now, so we have a net operating income of $42,000. If the current market value of the property is $600,000, you can calculate the cap rate as following. The cap rate equals the net operating income, NOI, divided by market value. And in this case, it's $42,000 net operating income divided by $600,000, or 0.07. So the cap rate of 7% indicates that the annual return you might expect from the investor. A higher cap rate typically suggests a higher potential rate of return. So cap rate is an important one that we want to understand as we're studying for the examination. Good luck with this. Practice a few, and then I'll see y'all in the next one. A classic that you see on real estate examinations, this is in the finance section of most books, is what is the difference between a discount point and a loan origination point? At the fundamental core, a point is a point. So all points are a percentage of the loan amount. 1 point equals 1% of the loan amount. So now what is the difference between a mortgage discount point and a loan origination point? Let's do it. So 1 point equals 1% of the loan amount. Number one, mortgage discount points are upfront fees paid to the lender at closing to reduce the interest on your loan. Now, discount points can be temporary or permanent discount rates. Okay, so they could be permanent discounts or temporary discounts. And in essence, you're prepaying the lender in advance to discount the rate in a fashion. It could be 3-2-1, it could be a permanent discount or whatever. Now, the benefit is a lower monthly payment. You can save a significant amount of money over the life of the loan, especially if you stay there for a long time. The incentive could be, if in a buyer's market, the seller could contribute towards buying down the consumer's rate, if the rates are high, by prepaying for that interest. The lender will take the prepayment because they'll be able to still yield or increased yield because the rates are lower over time. So they're increasing or front loading that profit margin for themselves up front. Now, loan origination points are charges by the lender to cover the costs of processing the mortgage application. This can include underwriting the loan, verifying financial information, and funding the loan. So this is sort of the business of doing the loan. Everybody that touches the loan file has to get paid for it, and loan origination fees are the fees that lenders charge to do all of that paperwork, basically. Discount points are to increase the lender's yield by and decreasing the borrower's over the lifetime payment on interest because they're buying down the rate. The difference is that discount points will reduce your interest rate and monthly payments, but loan origination points are simply fees that are paid at the point of origination. And by origination, we mean the loan. Now, hopefully that'll help you, give you some clarity there. Definitely something you want to know the difference for. You might also have to calculate these basically on exams, and you're good to go.